everyone. My name is Alex Josofsky, and I am the Director of Speaking Services here at ITR Economics. Thanks so much for joining me today. I wanted to take a few minutes to give you our outlook for the performance of various industries and components of the industrial economy as we look towards the course of 2019. I'd like to start by talking about machinery, and there are different components and different segments of the machinery sector that we assess. I wanted to give you a flavor of a couple of different varieties. So I want to start by talking about the metalworking machinery segment. This particular industry data comes from the U.S. Census Bureau, and according to their data, the U.S. metalworking machinery new orders were about $32 billion in 2018, and that represented growth of 1.9% relative to the previous year's level. Our forecast for that particular segment was in place for nearly a year and a half, but we did recently issue a new revised forecast, which included a bit of a downgrade. Our expectation is now of a mild decline into the middle of 2020. Basically, we're expecting mid-single digit contraction for that particular component of the machinery space this year. If we look at general industrial machinery new orders, this includes things like textile machinery and woodworking machinery, as well as packaging equipment. This is a $31.4 billion series in 2018, and that was actually exhibitive of 0.5% growth on a year-over-year basis. Despite the fact that it was above the year-ago level, we do expect that the 12-month moving total, or the value of this series, will decline through much of this year. The wood and semiconductor equipment sectors are examples of what's contained within the series, and both of those are expected to face some pressure this year. Similar to that of metalworking machinery, we expect a low single-digit decline for this particular subsegment of the OEM space in 2019, but that will be followed by high single-digit growth in 2020, so something positive to look forward to. If we look at construction machinery new orders, this is a large series, $35.7 billion in 2018, and that was a very healthy year for the sector. It was up 6.4% from the previous year. We do unfortunately expect spending to decline through this year. There's going to be a mid-single digit contraction on a rate of change basis, but there will be a recovery in early 2020. We think that non-residential construction and the rise in that sector should provide kind of a floor and should support construction machinery new orders somewhat in 2019, but that will give way to pressure from the non-residential sector in 2020, when we're expecting some contraction in that particular space. If we shift gears a little bit and talk about electrical equipment new orders, this was a series that saw 3.4% growth in 2018, but is actually expected to undergo a transition to phase C, what we call slowing growth, early this year. The rise in activity will happen at a diminishing pace over the first half of the year before actually turning into a mild decline into the second half of this year and into the early part of 2020. Essentially, expect a relatively flat performance, growth rates of roughly less than 0.5% over the next 2 years. So nothing overtly scary, but no real opportunity for big growth either. We think that the weakness in the housing sector will manifest itself in downward pressure on electrical equipment over the next 12 to 18 months. If we look at computers and electronics equipment new orders, this was also a series that saw very, very healthy growth in 2018. It was up 7.7% at the end of last year, but it will peak in the near term and then decline on a rate of change basis through the remainder of 2019. We've seen both imports and exports of electronic equipment transition to the backside of the cycle, but we do see imports are outperforming exports, and that suggests somewhat of a persistent level of consumer demand. We feel mild contraction is going to be the name of the game for this sector in 2019, and that will be followed by mid-single-digit growth in 2020. One area where we do see continued opportunity is the defense capital goods sector. This particular series was a $151.2 billion data stream in 2018, and that represented growth of 23.5% from the 2017 level. So really healthy level of growth for that particular series. Although we don't expect that double-digit growth rates will persist through 2019, and so our expectation is kind of temper your plans for investing in equipment and and additional capacity if you're involved in the defense industry, but still plan for mild mid-single digit growth in 2019 with the expectation that more robust growth will come back in 2020. If we look at automotive, the best way that we capture that data series is by looking at North America light vehicle production. Through the 12 months ending in January of 2019, that equaled nearly 17 million units, 16.9 million to be exact, and that was actually down 0.2% from the year ago level. We expect that production will remain relatively flat during the first half of this year, and that will eventually give way to some mid-single digit contraction by the end of 2019. We feel that the automotive tariffs being considered by the US administration right now could have significant negative consequences to the industry if they are to be enacted over the course of this year. When we consider oil and gas production, we're actually looking at this as an index, just like we are with automotive. This is a series sourced from the Federal Reserve Board, and this shows that U.S. oil and gas extraction production for the 12 months through January, once again, was up 15.8% from last year. That's a pretty substantial growth. We expect that production will rise through at least 2021, but those growth rates should flatten out a little bit and slow to kind of the mid-single digit level this year. We see that the U.S. rotary rig count and the U.S. natural gas rotary rig counts are now both in slowing growth trends, so still expanding but a slowing pace over time, and that supports our expectations of deceleration this year in overall U.S. oil and gas production. For the chemical sector, our expectations are also milder this year than they were last year. The chemical and chemical products production series through January for the previous 12 months, that was up 3.9% over the course of that period of time. This particular segment is driven quite a bit by pharmaceutical and medicine production, which makes up roughly 40% of the total series, and that component is actually outperforming the sector as a whole. We do think that production activity in chemicals will rise through the majority of 2019 and then generally plateau through the majority of 2020. If you're in aerospace, we think that civilian aircraft equipment production is going to have a better year in 2019 than it did in 2018. Last year, it was down by low single-digit rate, but this is a counter-cyclical industry, and we do expect a return to mid-single-digit growth this year. We don't believe that the Boeing's latest troubles with the 737 MAX or the Commercial Aircraft Corporation of China's introduction of the new narrow-body C919 will have any kind of near-term implication on domestic production of aircraft in the United States. Finally, another counter-cyclical sector that I wanted to explore is medical equipment and supplies. This particular series was 1.4% below the year-ago level in January. And this is another counter-cyclical sector, as I mentioned, that is expected to grow by mid-single-digit rate in 2019. We feel that the hospital construction series does have about a 3-quarter lead time to this particular production indicator, and it suggests that medical equipment production will peak in mid to late 2019, signaling an eventual slowing growth phase for medical equipment will emerge in the second half of this year. So with that, kind of concludes my quick overview of the industrial sectors in the U.S. economy and what we expect to happen over the course of 2019. Certainly, each one of those represents an opportunity in and of itself, but it really highlights that this year it's all about resource deployment. Make sure that your sales efforts and your marketing activities are targeting the sectors that are poised for most growth this year, and don't spend a whole lot of time or resources pursuing sectors that are expected to contract, because as you'll find, the ROI in that endeavor will be quite low. I hope to talk to you again soon and give you another update on what's going on in the U.S. economy in the coming weeks. Have a great day and take care.